Real signs of a healthy real estate market. Purchasing a home can be challenging due to the various factors that influence the housing market. For instance, the COVID-19 pandemic has significantly affected the housing market over the past few years. Most areas in the country have experienced a shortage of homes, leading to a spike in both sales and prices. The competition among homebuyers is intense, with many having to offer well above the asking price to even be considered by sellers. While the pandemic had a major impact on housings in the United States, it's important to note that such events are rare and unlikely to happen again soon. Though the housing market can be unpredictable at times, buying real estate doesn't have to be a gamble. If you want to gauge whether the market is stable, we've compiled a list of indicators of positive growth from various real estate sources. These signs, such as fewer distressed properties, lower mortgage rates, and rising home prices, can help you assess the health of the housing market. Here's what you should know. Young people are buying starter homes instead of renting. A high demand for starter homes is a strong indicator that the real estate market is doing well. When the market is uncertain, young and first-time buyers often choose to rent instead of purchasing a home. However, in a strong market, young people feel confident buying starter homes, which are usually small and affordable. This increases competition for these homes, which often sell quickly in a healthy market. Foreclosure and short sales are hard to find. In a healthy housing market, there are fewer foreclosures and short sales. When the market is struggling, you'll find more distressed properties for sale because homeowners are having difficulty finding buyers and keeping up with mortgage payments. On the other hand, when there are only a few distressed properties on the market, it indicates that the housing market is strong, with homes selling quickly and financial stress on sellers being minimized. Asking price has increased at a steady pace. In a weak housing market, home prices tend to decrease as sellers try to attract buyers. In contrast, a healthy market sees a gradual increase in asking prices. High demand from buyers allow home buyers to raise their asking prices over time, which keeps the market moving steadily. However, prices should rise at a moderate pace. Too rapid or too slow of a change can signal an unstable market. Mortgage rates are lower than normal. Mortgage rates are another key indicator of a healthy housing market. When the market is down, lenders raise interest rates to cover losses from foreclosures or distressed properties. In a strong market, buyers are more likely to offer larger down payments and have better credit, reducing the risk for lenders. As a result, lenders can offer lower interest rates, further stimulating the market by making home purchases and refinances more affordable. Real estate companies are thriving and hiring. When real estate companies are growing and hiring, it's a good sign that the market is strong. Both buyers and sellers need the services of real estate agents, and companies will hire more agents to keep up with the demand in a healthy market. Seeing new faces in the industry and more job openings for agents are signs that the market is thriving. Conversely, a downturn usually leads to lower earning for agents, fewer job opportunities, and some agents leaving the industry. The unemployment rate is low. Low unemployment rates have a positive effect on the housing market. When people have stable jobs, they're more likely to save for down payments and feel confident making large purchases like a home. High unemployment, on the other hand, makes home buying seem risky, leading to more people choosing to rent instead. For sale signs are hard to spot. A lack of for sale signs can actually be a good sign that the housing market is healthy. In a weak market, homes stay on the market longer, with signs lingering in yards for months. But in a strong market, homes go under contract quickly, so the signs don't stay up for long. If you notice many for sale signs in your area, it might indicate an oversupply of homes and a downturn in the market. Stat shows housing affordability. A healthy housing market is one where more people can afford to buy homes. The National Associations of Realtors Housing Affordability Index tracks this by measuring how many families can afford to purchase a home based on median income levels. A higher index percentage indicates more potential buyers, which suggests to a stronger market. The list to sell ratio is above 100%. The list to sell ratio, which compares the actual sales price to the asking price, is another sign of a healthy market. A ratio above 100% means homes are selling for more than the asking price, a sign of strong demand and a healthy market. A ratio below 100% suggests that buyers aren't as eager, indicating a weaker market. Sellers are also making home purchases. In a strong market, sellers feel confident enough to purchase more expensive homes after selling their current ones. In a weaker market, sellers might sell their homes to relieve financial stress and choose to rent rather than buy again immediately. When sellers are upgrading to larger, pricier homes, it's a sign that the market is in good shape. Housing market prediction for 2024. When will prices be affordable again? Let us just touch base with this quickly since we're talking about the real estate market already. The housing market may be entering a period of change. While summer sales have been slow, there are signs that activities could pick up as mortgage rates decrease and more resale homes become available, giving buyers more choices. The median price for new builds has also dropped below that of resale homes, with builders offering incentives to attract buyers. However, experts believe the market will only gain momentum with mortgage rate drops, enough to make homes more affordable and encourage homeowners to sell, increasing the inventory to meet demands. We'll discuss more of this in the upcoming episode. So, the bottom line is, keep in mind that the real estate market can vary by location, and positive signs in one area might not apply to another.